I'm Steve Forbes, and you're watching Traders Nation.
Welcome back. You are tuned in to Traders Nation. My pleasure to have with us here today Jason Hartman. He's CEO of JasonHartman.com, certainly. Jason, welcome to Traders Nation. How are you today?
Thanks. It's great to be here.
Oh, good, Jason. So construction costs are high. Folks are holding on to, and then they're holding on to their homes because of rising interest rates. Is this a perfect storm, Jason, for a housing shortage?
Well, it is definitely a perfect storm for a housing shortage. We've been experiencing a housing shortage for the past several years, but I don't think it's been worse than this in an awfully long time, many decades. I've been through several cycles.
Sure.
And one of the interesting things that you alluded to is how people are holding on to their houses. Now, what's interesting about that is that they have these very low interest rate loans that they got a few years back.
Sure.
And, there's not a lot of motivation to sell because when you sell the mortgage, and the mortgage is a big part of the asset.
Yeah, it certainly is. Interest rates are going up. They have been, right? And they're starting to move, and probably anticipated to go even higher. And I think that's a really good point. People do the math. They're smart, right? They do the math, and they say, hey, this is going to cost me a lot of money to get out of what I have. I must really want the next home to move on to afford that larger interest rate and that larger payment, potentially.
You are absolutely right. And just so your listeners have kind of a metric for, there's always people out there predicting a housing bubble, too, on the other side of the equation.
Sure.
When will these high prices stop?
Sure.
Well, the adjustment has to be rather significant compared to the interest rates. Every 1% in interest rate in mortgage rates equals about 10% in price. So when rates go up by 1%, you need to see a price reduction of 10% on the typical loan to have that be equal.
Sure.
So the simple result is people have to pay more and they get less. That's just the way the supply and demand equation pans out.
Right. Well, you mentioned real quickly, and I didn't want to get into the housing bubble thing, but you mentioned, so certainly it's something worth talking about.
Sure.
Concerns about a housing bubble. A lot of people got stung. I had some properties up north. I had a condo on the beach in California, here in Arizona, and then so I certainly shed my properties because it was a good time. I was going to make money, and I didn't want to be holding on to these properties. So with the housing bubble, people got stung, and some people got stung really bad. Have we got enough years behind us where the people have kind of are feeling a little bit not so tender to that sting? Are people still worried about that? Are we going to run into another housing bubble, you feel?
Well, that's the million-dollar question, isn't it? And I always say, we Americans, we have a very short memory.
Yeah.
So, it's just funny how that works. But, I got to tell you, first of all, we have to distinguish between different types of markets. There are basically around the world, around the country, three types of housing markets. There are linear markets, there are cyclical markets, and there are hybrid markets. Now, linear markets, as the name would imply, are the markets that just sort of chug along. They don't make the news. They're places that we like to invest. My company helps people invest nationwide. We invest in places like Atlanta, Memphis. Now, we used to invest in Phoenix, but Phoenix is a hybrid market. And so that market is kind of in between the two. The very risky, dangerous markets are places like the West Coast,
Sure.
L.A., San Francisco, San Diego, the expensive northeastern markets, New York, Washington, Boston, South Florida.
Sure.
These markets are crazy. They never make sense. They're highly risky, and you got to time it just right, or you're in big trouble.
Well, I was going to ask you what makes them risky, but is it volatility in these markets? It says you better know your market area if you're going to come in and invest in that market. What is it?
In my many decades in this business, I have never met anyone that can accurately predict the cycles. So for my money, being a little more conservative as the years go on, just invest in the linear or hybrid markets.
Yeah.
Because you don't have to time the market in those markets.
Right.
They will make sense from a cash flow perspective. So when you buy an income property in these linear markets especially, you're just investing for yield. And if overall your yield's going to be somewhere in the neighborhood of 20% annually, heck, What's wrong with that?
Sure.
Just keep it. Just sit and be in for the ride.
That's right.
You know, the cyclical markets, if you time it right and you buy property in Los Angeles or something and you're at the bottom of the cycle and you ride it up to the top, you're going to make a fortune. But nobody can accurately predict that. You know, it's just, it's a fool's game.
That's right. I almost don't think that, and I don't know the future. Like you said, it's $1 million question. I don't know if we'll see such a dramatic crash in the housing market that we've seen. Maybe not in my lifetime. Maybe down the road.
I agree.
I don't know if we'll actually see that again, and certainly that was a fantastic buying opportunity. I don't know if we're going to see that kind of buying opportunity now. I think it's going to be like anything else that one may invest. It's you invest it, you think you're in the market, and you find a soft spot. You may see some appreciation there, and then you're betting on the appreciation over time is what I'm thinking. And I could have bet you're a linear market guy. All right, so since inventory's slim, what kind of property appreciation can we expect? I know it's in areas. Phoenix certainly is one, but in the national market, it's going to be different from Phoenix. But on the average, what do you think? What kind of appreciation that we may expect?
Oh my God, that's another $1 million question. Well, historically,
that's why I ask them. That's why I ask them. That's why that's why they tune in, right?
You can ask, but I don't know anybody who can answer reliably. But,
That's right.
But, you know, look, at nationwide, over the course of many decades, most people will tell you, and of course, you know, there are about 400 markets in the United States. It's a very large, diverse country, obviously. But nationwide, typically people are looking at about a 6% annualized average appreciation rate, somewhere in that number when you mix in all the markets. The problem with those cyclical markets is, you know, you give back so much during the bad times. And to your point earlier, the Great Recession that we went through was an anomaly. Okay, there will always be cycles in markets, of course. Typically about every 10 years, you'll have a 3-year cycle. That's commonplace. But, you know, that was the worst economy in 7 decades. That was not normal. And this time around, you know, the banks, I would argue that they've overcorrected. They've been extremely conservative. There are little pockets of crazy lending, but nothing like what we had in the early 2000s. They were making loans that you just knew there would be a foreclosure crisis. It was so obvious that would happen. Now, what wasn't obvious, I mean, I predicted that part of the collapse. What I didn't know is what was going on Wall Street, where they were bundling these loans, selling them multiple times. That was all behind the scenes. There were really two punches in that Great Recession. The first one was the mortgage crisis. That was kind of obvious. I knew that was coming. The loans were stupid that they were making. They were completely crazy. But the Wall Street component, I didn't know about that one.
Well,
so
and that's the other factor that you couldn't factor in and a lot of people couldn't because, like you said, these are the types. Let's face it, Wall Street's. I'm in the area. Wall Street gets really creative, sometimes too creative, right? And you don't know how creative some of these things are being sold in the creative market. So not everybody's privy to that kind of creativity, and hopefully they won't do it again.
And that's a very kind word, creativity.
That's right. That's right, Jason.
I call it criminal behavior, but creativity, sure. Okay, go for it.
That's right.
Love it.
That's right. So yeah, you're right. I think that's what we're seeing. All right, so we're almost out of time. Despite rising prices, do Americans want in, and are there any barriers that they may face? They need to know ahead of time, Jason.
Did you say barriers or
barriers? Yeah, barriers. Certainly barriers.
Yeah. Well, you know, qualifying for a loan nowadays is pretty difficult, which leads me, you know, to my last point, to think that there's not going to be another big crisis because these lenders are not giving loans away to people who can fog a mirror anymore. They are much tougher, and the underwriting is much more solid. So,
as it should be.
You know,
it should be.
There are certainly challenges.
Yeah, we're out of time. I'm not against that. I think you got to have a little skin in the game. And instead of hardly none like before. JasonHartman.com, JasonHartman.com, where you can find you, right, Jason?
Yep. Thank you very much. JasonHartman.com. We got a lot more there for you.
All right. Have a great day. Thanks.